welcome to the first online meetup that we've done as part of the Melbourne Investing Meetup. Glad to see a good turnout so far, and I'm sure people are coming in as we go. It's a exciting presentation this evening. We've got John Locke from the USA going to talk to us about the pathway to becoming a successful options trader. John is internationally known as a trading performance coach and an advanced options strategy developer. He has his own company called Lock In Your Success, very well regarded in the industry. He stands out as a top professional trader on S&B Capital's option trading desk. So he trades large sums of capital for S&B Capital, and so he's not only teaching, he's doing what he teaches, which is very important. He has many successful educational programs, including the Bearish Butterfly, the M3, RUT, Super Simple Spreads, and so on. He's also specializes in coaching and trading psychology, and I'm sure he'll tell you a little bit about his background in his presentation. So I'm very proud and excited to have John here tonight to speak to everyone here, and I'll just leave it at that. But the one last thing I must do before we continue with John's presentation is just give you a whole pile of words that adds up to one very simple thing. What we're providing tonight is purely an educational seminar. It's in no means trying to incite you to purchase or sell any form of financial instrument, and we don't know whether trading is appropriate for you. All trading involves some form of risk, so we're not trying to tell you to invest or divest yourself of any financial product. And now that that's been said, I'd like to hand over to John Locke for his presentation. Thanks, John.
Thanks, Kevin. I appreciate it. And good, I guess good evening, everybody over there in Australia. It's early in the morning for me over here. Let me switch my screen. I will make myself presenter. There we go. Well, welcome, everybody. I'd like to thank you for joining me as we explore the path to becoming a successful options trader. I'm just going to talk a little bit about my journey, and you can follow along. You might notice some familiar things that you may be going through as well. Feel free, as you tag along, to ask any questions. You can type them into the questions box, and Kevin and I believe, are both watching it, right, Kevin? And
that's right.
We'll get to them as quickly as we can, or as many as we can. So anyway, I started trading options about 10 years ago. I knew absolutely nothing about the market. I was actually a life and success coach. And I began by taking a lot of the popular options trading courses, not options trading, but trading courses available at the time. And I started trading directionally on stocks, like most people generally do. So I took a whole bunch of courses where I learned a lot of information about swing trading, day trading. We did Forex, all different types of directional trading, and also what we call income trading, options trading. I bet I spent probably at least 40 hours a week for many, many months back trading, paper trading, live trading, all kinds of things. But unfortunately, no matter how hard I tried, I had very sporadic results. I ended up jumping from one trading style to another, grasping on at anything that might be better than what I was doing. So I was basically on this continuous cycle of learning more and more about things that were very, very interesting, but in reality had no real relevance to helping me perform better as a trader. I was just jumping around from one style to another, getting nowhere. So I continued on this cycle until one day I said, you know, trading is just like anything else. The reality is that I already know enough to be making money in the market. The problem is that I'm not applying it correctly. So I decided to myself, it's time to take the success principles that I knew from success and life coaching and apply them to trading. So what I did is I I figured out what I wanted from trading. I set my goals. I chose a single style of trading. I shut everything else off, chose a single style of trading on a single asset, and I worked on that strategy over and over and over until it produced the results that I wanted. And that is a process that took me from being a guy who knew absolutely nothing about trading, I never traded a stock, to being the top trader on a professional trading desk and an educator in the industry, where myself and others trade millions and millions of dollars using these strategies. And these are the same strategies that I teach retail traders, and they're the same strategies that we're going to talk about tonight. And one thing that I know is that I can teach this to you because I've done it with hundreds of traders. We've taken people who have known nothing about trading, and within a year have had them trading on the options desk and doing very, very well. So it doesn't matter where you're starting from, because if I can do it, then you can do it too. So let's talk about how we might do that. Let me just move forward here. This is the same thing, our typical disclaimer, which is essentially what Kevin said. The only thing I would like to add is that the risk in trading options specifically, which we're going to be talking about, is very high, and you might want to make sure you're aware of all your risks prior to placing any trades, and make sure you visit, you're going to get this from your broker, but you can go to cboe.com and get an options risk disclaimer. Also, we are going to be using some hypothetical performance trades on our examples, and those trades are believed to be as accurately represented as possible. However, live results can vary from hypothetical. So just keep that in mind. All right, so let me just, before we get into this, let me just quickly show you my website. This is lockeinyoursuccess.com. This is my website. A couple of things that we have going on and for free that you can look at. If you look under freebies and more, I do an options trading income weekly webinar every week. If you come into there, this is free for everybody. It is 9 a.m. Eastern, but so that may not be a great time for you guys, but the recordings are available on the blog. So, and that's free. Something I do for free for people who are interested in the strategies in this type of trading. And you just go down the bottom here, and you can sign your name in, and you can join us for those webinars. They're posted on the blog. If you just go to the blog here, we post them in podcast format now. This is relatively new, and we post them in video format. They're about a half an hour long, and I've been doing this in one form or another since 2011. So essentially what we've done is that we take some of the trades from some of the programs I have, and we track them month after month. They are hypothetical trades, however, they are done real time, and they're done as the trade unfolds. So that gives you an example of that. So that's pretty cool there. And of course, there's a lot of other cool things on the site as well. But I just figured I'd quickly mention that before we move forward. Okay, so moving on. Let's talk about trading. So whenever I talk to traders, I always emphasize how important it is to know why you're trading and to have trading goals. And I do this because I see aspiring traders all the time who come into this business without thinking about what they really want. They'll say something like, I want to quit my job, or I want to make money, and they'll proceed to spend tens of thousands of dollars and years of their lives hopping around from one type of trading to another, kind of like a desperate, drowning person grasping at anything that might keep them afloat. And if they finally get to a point where they can actually make money, they often don't like it. So in other words, they've wasted a bunch of time. And this is evidenced by a client I had recently who said, he sent me email saying, I've spent $100,000 learning to trade so I could make enough money to quit my job. And after 7 years, I'm finally profitable enough to do it. So I said, hey, that's awesome. How can I help you? And he says to me, well, the trading I'm doing is the most time-demanding and stressful thing I've ever done in my entire life. I hate it. And I said, really? What type of trading do you do? Day trading. And I say, now I understand. You see, on the surface, this guy got into trading because he wanted more money. And after 7 years of hard work, he finally got what he asked for. The problem is that what he really wanted was time freedom and stress reduction. And that is not something that day trading is going to give you. There are types of trading that you can do that with, but it's certainly not day trading. He spent years climbing the ladder of success, and when he finally got to the top, he found out that the ladder is leaning against the wrong wall. Now, this isn't the best way to spend the limited amount of time you have on the planet. So what we're saying here is just make sure that you know what you want, and make sure whatever type of trading you're learning is going to fit into that picture, because you don't want to spend years doing the wrong thing. Now, you guys being from Australia, I'm sure that your ideal life would probably include sleeping through the night. So what I'd like to do is take a look at how we might be able to trade the U.S. markets here without the need to watch the market all day by using options. Of course, you are going to need to spend a little bit of time each day to just check your positions and possibly make adjustments. I believe it's, 5:30 to 6:30 in the morning when it's around 3 o'clock here, which is basically the time frame that we generally check things. So I'm assuming everybody here knows what a call and put option is. But beyond that, I'm not sure what you know about them. So I'm going to do a quick review about just how they're used. So when most traders start using options, they're typically swing traders or sometimes day traders, and they use them for directional leverage directional plays. So there could be a situation where I'm considering buying 100 shares of Apple for $115 a share, and I'm hoping the price goes up so that I can make some money. If that were the case, and I bought 100 shares of Apple for $115 and it went to $120 the next day, I would have risked $11,500. That would be my investment to make $500, 4% gain. That's pretty good. If I wanted to do options, let's say I took that $11,500 and I bought October 150 strike call options, and when I made this example, the options were $305 each, so I could have gotten 37 of them, and I could control 3,700 shares of Apple. Now if Apple goes up that $5 the next day, the option value would likely double to about $600. In this case, I risked $11,500 to make $11,250. So that's almost 100% in one day. And it sounds much better. So you might ask, well, why don't I use options all the time? Why would I ever buy a stock if I can do that? And the answer to that comes in the answer of risk and probabilities. First of all, if you could only afford $11,500 of Apple stock, spending $11,500 on an Apple option is would be something I would never do. It would not be very responsible, because you're likely to lose. You're much more likely to lose 100% of your investment buying an option than you would if you were buying a stock. And I think most people understand that. But what a lot of people don't understand is that you're also much less likely to make any money at all buying an option versus buying a stock. And let me explain that. This here is an analytical graph. I don't know how many people of you have seen this. I mean, a lot of people know what a stock graph is. This is a little bit different. This essentially shows the price of the stock on the bottom, and it shows the profit and loss of your position as it moves. The green solid line basically represents what your profit and loss is going to be at each individual price point. So if we bought this stock at about $115, our profit and loss should be zero. If the stock went up to about 120 and you just go over and you just look at your profit and loss here, it would probably be a little bit under $1,000. in this particular example. Generally, when you buy a stock, you have a slightly less than 50-50 shot at winning. If the price doesn't move, you don't win anything. If the price goes down, you lose, barring commissions, of course. And if the price goes up, then you win. So it's virtually almost a 50-50 shot at winning. If I come and do an option, that's a bit of a different story. This represents the same size position as the other trade did. We have the solid line, which represents what I call the actual value of the option. And we have a dotted line, which represents the actual value of the option plus the time value in an option. Options have time value. When you buy an option to buy a stock, you're purchasing sometimes intrinsic value or actual value and time value. If we do a straight at the money option, they don't have any actual value. It's all time value. So here, essentially what happens is you have this dotted line. Again, I call it time value. Some people call it different things, extrinsic value, volatility value, but I just call it time value because it's easy and understandable for people. Generally what's going to happen here is you're going to buy an option like this, and over time this dotted line drops in to meet the value of this regular line, which essentially means that if Apple goes down a little bit, you're very likely to lose all your money. If Apple goes down, if Apple doesn't move and you hold this till expiration and a lot of time goes by, you still lose all your money. As a matter of fact, Apple can even go up a reasonable amount in this case, and you could still lose a significant amount of money. So here you have a lot less than a 50-50 shot of making any money. The market has to move. It has to move relatively quickly, or it has to move a lot in order for you to actually make anything. And that makes things a lot more risky. So because of this, many traders, okay, so just as a review, buying options has a very high risk of loss, a decent loss of losing 100% depending on where you buy it, and generally a low probability of winning. So we can change that risk and probability by altering what strike choice we have. If we do a deep in the money call, for an example, it acts more like a stock. So if Apple's at $115 and I buy a $50 option, which may not even be available, but if I was able to do a $50 strike option, it would act very much like the stock, and the probabilities would be there. On the other hand, if I did something out of the money, what they call out of the money, and I bought something at a strike price of $120, the chances of that ever making anything are very, very, very small. So the question comes in, why don't I sell options? If I do that, I have a greater than 50-50 shot of actually making something. I could sell that call option instead of buying a call option. We have our solid line, we have our dotted line. As time goes by, our dotted line is going to meet our solid line, which essentially means that if the price goes down, I can quickly make money. If the price sits here and time goes by, I still may be able to make my money. And the market can actually go up all the way to about 118 here, and I could maybe still make something. So now I have a significantly better shot at winning. I could also sell puts if I was bullish, right? So obviously that play before here, this would be a bearish play, thinking the stock's going down. This would be a bullish play, thinking the stock's going up. And I basically have the same type of thing. I can come in here, and as long as Apple doesn't go below a certain amount, I make money. Higher probability than making money with a stock. Everything comes at a cost, though. There are costs to doing this. And one thing is the very large amount of risk that you have in selling a put option, as we would call it, naked. If you sell a put option naked, you essentially take on the same risk as buying the stock to the downside. So if I were to do this and the price were to come down a lot, I'm taking on that risk. That's perfectly okay if I want to buy the stock. In other words, a lot of people do this as an alternative to buying stock. I could come in here and buy Apple at $115 today, for example, because that's the price of Apple. If I want a better chance of winning, I can come in here and I can sell a put at 115 strike level. That way I make money, and if the price goes up, I still make money. If the price sits, I still make money. If the price comes down a little bit, I may still make money. But if the price comes down and closes below my short strike, then I'm responsible for the stock, and I will get assigned that stock at $115. But the good part is even if I get assigned, I've collected a little bit of time premium, and it helps offset the cost of that. Now I own the stock, and we can do something from there. So that's great. Another thing, if you sell the call, you also have a ton of risk. If I sold Apple at $115 if I sold an Apple call at $115 strike, and Apple went up to $200 the next day because some kind of crazy good news came out about something they're launching or whatever, I could lose a whole boatload of money here. So they tend to be fairly risky. And that's the payoff that you have for your probabilities. Now, if I own the stock, if I owned Apple, I could sell the calls, because essentially what happens if I get assigned a short call on Apple, in this example here, I would be short 100 shares of Apple at whatever cost my strike level is. So if I'm here and if I sold a call on Apple and Apple went up $10, I'd still have to, I would be short Apple at 115, and I'd have to provide it back to my broker, and buying it back at $120 would be a loss, for example. So what some people do, if you already own the stock, that's fine. So if I owned 100 shares of Apple and I sold that call, it's a way for me to collect income if Apple does not go up, but it is also a good chance I might get my stock taken away from me if it does go up, and I might miss out on gains. So there are risks both ways. But if you're going to play this without wanting to buy the stock ever, generally we recommend doing something called a vertical spread. It's a way to reduce your risk if you're going to do this. So in this particular case, what you do is you sell an option at a certain strike level, and then you go out and you buy a cheaper priced option to cover your risk to the downside. So here, I still have a better chance at making money than if I bought the stock. I have very high probability, but I also have greatly reduced my risk if the market goes back against me. So this would be a bullish vertical spread. You can also do a bearish vertical spread if you were bearish. Or you could do something called, you can combine those together and do something called a butterfly spread. This is where I sold a call, which would technically be an iron butterfly for those of you who are more advanced, but we'll stay out of the terminology because I don't want to confuse anybody. But if I sold a call and a put at the money, or basically at the same strike, and I bought some options to cover my risk, then I have a butterfly spread. In this case here, if the market doesn't go anywhere, I actually end up making a lot of money, but if the market stays between what I call my break-evens on my expiration graph, which are here and here, then I make something. If I go beyond that, then I'm generally going to lose money, depending on how long I hold it, obviously. That's called a butterfly spread. Now we can take these and spread them apart and do what's called a Condor spread, where I sell something that's a little bit out of the money on this side, a little out of the money on that side. Gives me a wider range of potential profit here, and I can do that as well. Now, if this stock obviously stays between here and here, in theory, right, we're going to say in theory, I can make money. Not that you'd actually ever hold it that long. But over time, as long as it doesn't go too far, I make something. So those are the types of, and these are the types of trading that I do. Well, it's an introduction to that, because we call this income trading or market neutral trading. If you're going to think about doing market neutral trading and you're going to sleep during market hours, I would avoid trading stocks. The thing about an individual stock is extremely good or extremely bad news about a certain company can cut stocks in value in half, or they can double virtually overnight. So sometimes in the same day. It's unusual, but it does happen. What I'd rather see you guys doing is trading indexes or broad-based ETFs. It's very, very rare to have more than a 5% move in a index, a broad-based index, or a broad-based ETF. And that inherently, if you're going to be doing a market neutral type of trade, is going to make them much, much safer to trade. Because the thing about market neutral trades is I'm still risking a lot of money to make a little bit of money. And if I get a 50% move in this, I'm going to lose all the money I have invested. I'm going to be happy that I have long options to cover myself, but I don't want that to happen. So because of that, we want to stay in something that's a little bit more diversified than a regular stock. The systems that I trade and that I teach, we trade them on the Russell 2000, and they're designed to be checked one time a day. So let's just move forward here. This is a Russell Condor. I don't trade Russell Condors. It's a strategy that a lot of market neutral income traders teach, and there's some inherent problems with iron condors. When they work well, most iron condor strategies, when they work well, they do very well. You can have months of small amounts of income trading them, but when they go bad, a lot of times people end up taking losses a lot more than they think. Now, this would be a fairly high probability trade. The thing with this is, you start getting some fast moves, you start losing value very quickly in these positions here, which can be problematic. Plus, they have risk whether the market goes up or whether the market goes down. So even though this is a trade like this is marketed through the general options community as a high probability trade, they'll say something like, one of the things that we do when we sell options is we take a look at what the probability of this expiring in the money is. And they'll say, well, this is a trade that has, just for example, and I don't know what the actual probability of this example is, but they'll sell a short strike here that says, I have a 95% chance that that's going to expire out of the money, and they'll say, I'm going to pick the call option that also has a 95% chance of expiring out of the money, and they'll say that this is a trade that has a 95% probability of winning, which may be true if you were to take this position, hold it, and do nothing, no matter what happened. In other words, if you were really willing to risk $25,000 to make about $4,000, and you were willing to take that $25,000 loss and hope that things worked out, then yes, that may be statistically a 95%. It may be statistically a 95% probability of winning. But in reality, trading that way is not responsible, because that means that you have to win at least 5 or 6 times. You have to win this 5 or 6, let it expire and win it 5 or 6 times to even cover one loss. Now, these are high probability trades, but they're not that high probability. And taking a loss, if you take 2 or 3 losses in a row, you can wipe yourself out. So therefore, we're generally not going to be able to hold this position until we get to these strike levels. The reality is, for the most part, you're only going to be able to hold this to maybe this area here, or let me go back, or maybe this area right here. which means you no longer have a 95. If you're going to get knocked out of the trade by keeping a responsible loss level at way up in here, that might mean that you don't have a 90% chance on that option anymore. You only have maybe an 80%. Okay. The other thing is not all, I'm selling both sides, which means if I have an 80% chance of winning, I have a 20% chance of losing. And if I have a 20% chance of losing over here, and I have a 20% chance of losing over here because I've sold both sides, that means I have a much less than 80% chance of winning. It's more in the 60% chance of winning. Still, a nice high probability trade, but it still can be problematic where you're going to lose a lot more than you think you're going to lose. And that's even if the market stays within its standard deviations and probabilities, which it usually doesn't. It usually actually goes beyond them. So just something to think about. So what I do instead with my beginner traders is we talk about just doing bull verticals. Now, the thing with bull verticals is if you sell an option where you have a 95% chance of it expiring out of the money, you actually your chances in a bull vertical of winning a bull vertical are almost double what they are of winning a condor. They're slightly less than double. And since the market spends most of its time, not most of the price necessarily, but most of its time going up, a bull vertical spread trade is actually a very, very, very high probability trade. And it doesn't really matter if you sell a 10% chance of winning or a 50% chance of winning. The results are generally the same. Since the market generally goes up and you're in a high probability trade, a trade like this is going to win most of the time. And the simplest trade that we run in the super simple spread trades is just doing a simple bull vertical trade on the Russell with no adjustments, and you just go for it. So, I can explain this to you real easy. We sell a option that has a 10 delta, which is a 90% chance of making money statistically or expiring out of the money. We do a 30-point wing. We do this 65 days to expiration. We run it until the following month is 65 days to expiration, and we simply close the position. If you were to do that, right? I mean, think about how much trouble people have making money in the market. I see traders all the time. They struggle for years and years and years, and they're losing money. I'm like, what are you doing? If you were just to simply do that and nothing else, right? You could be profitable in the market, and you could beat most mutual funds. So, as a matter of fact, if you were to do that, and you did that, and you go back and back trade it, since 2002, we average 9 wins and 3 losses any given year. We have only 2 losing years, 2008 and 2002. And you kill the returns if you were just to buy S&P stock and basically hold it, right? And these are just simple returns. So just something like that is enough to make, if all you're looking for is to, something that's very easy to manage, that you want to put in your retirement account, you can actually do something that simple and make money. So that's really, really cool. And again, basic rules for that. If you want to email me, I can just tell you the basic rules for that. That said, we are due for a losing year. 2002, 6 years 2008, 6 years 2014. We did not have our losing year in 2014. 2015 could be that year because it's been so bearish. We'll have to wait and see. But very, very good, just a little system for making money. So the question becomes, well, what about those losing years? I think if you were actually experienced 2002, you could probably tell that it was a bearish year. I think if you were in 2008, you could probably tell that it was a bearish year. You could do a bear vertical. Now, I don't generally do bear verticals, and I do sell the put verticals, credit spreads, and they're very effective. These here, on the other hand, are not so effective. In other words, this is the same reason I generally don't trade condors. And that's because when you do a bearish vertical, two things happen. First of all, you get very little credit for that side of the transaction on an index. That may not be true for a stock, because a stock often has the possibility of gapping up so high. But an index, they're generally not too concerned about it going too high, so they're generally going to not give you a whole lot of credit to sell your bearish call vertical. That being the case, there's not a whole lot of room here before, if you're going to trade responsibly and exit this trade when your credit is received, which I didn't mention on the bull vertical. Generally, when we do the bull vertical, we're going to do something like this. We're going to put this trade on. We're going to stay in this for our time frame. If at any time in the time frame we hit a loss of the credit that we get, so in this case here we got about, just say, $2,500 credit. If the market comes down quickly or extensively and we reach the point where the trade is actually drawn down $2,500, we're just going to exit the trade at a loss, and we're going to wait till the next month. And that's going to be responsible trading. You don't want to sit in here until you've lost, $28,000. So that would not be responsible. So if you're going to trade that way on a call spread, you have very, very little room for the market to move up before you hit your loss numbers, and that makes this a relatively low probability trade. And even if it does work out, you generally don't make a whole bunch of money. So generally, I tend to avoid bearish verticals. What I do instead is something that we call a bear trade, which again is in the SSS trading system. This is simply a bearishly positioned butterfly. But it also has, it also scales in or changes as the market goes against you. So if I sell a bearishly positioned butterfly and the market comes down, unless it's a complete market crash overnight, which generally isn't going to happen in an index, right? Because this thing could go 60 points. The biggest move ever in a day in the Russell 2000, 64 points to the downside. And that was in flash crash time. So even if I were to take this and go 64 points down in a day, this is still profitable. Even with a volatility increase, for those guys who know what I'm talking about there, this is still a profitable position, even if that happens. If the market is a little bit less aggressive to the downside, you can make a lot of money here, just taking that bearish bet, especially in a bearish market. Here, if the market sits, I can still make money. If the market takes off to the upside, the bear trade has a method that you trade it where you actually increase your position size as the market goes against you. Again, this is a bearish trade. So if the market were to go up and then come down, again, you could make a very, very substantial amount of money. As a matter of fact, I usually like, when I put a bear trade on, you're usually not going to call a complete top of the market. But when I put the bear trade on, I'm generally near the top. And what I would like is the market to go up 15 to 40 points and then do its retracement. So if that actually does happen, or if I'm wrong by a fairly significant amount, I can still generally make a lot of money here. So this particular trade is an example of a trade that we just closed out. If you look at the weekly updates, for a 30% or almost 100% of actual capital, but a 30% of what we call planned capital. One of the things that we do when we do our trading systems and we put them together is we don't base our profits off of the actual money we have invested in the stock market. We base our profits off of a number that represents what the most we're likely to have in a trade. So going back when we talk about these types of trades, generally when you have a condor with an adjustment strategy or you have a butterfly with an adjustment strategy, generally when you start the trade you have a lot less money in the trade than you will later on if things go poorly. That being the case, we want to make sure that our profits and losses and the way we call our percentages are actually representative of what we should, the maximum amount we're putting aside for the trade. So we always do that. So in a trade like this, this has what we call a planned capital of $50,000. Therefore, if I make a 30% profit off of $50,000, I'm making $15,000. I'm not, in this particular case here, with this trade, I only have $18,000 in the trade, but I have a $50,000 planned capital, so I might get up to $50,000 in it. Therefore, if I pull back, I make $15,000. I say I made 30% of my planned capital, not 100% of what I had invested. Those are the numbers that a lot of these marketers will tell you when they're doing these trades. And the problem with that is when you lose a trade like this, you're going to have a lot more money in it than when you win a trade like this most of the time, which basically means you're taking 30%. You know, these guys are showing you, they're saying, we're making 100% gain. Yeah, they're making 100% gain on $1,000 and they're making a 10% loss on $10,000, and they're saying that they made a certain percentage, when that's not the case. The case is they broke even, right? So just something to do that as we go along. But anyway, this would be an example of a bear trade within the SSS system. Now, those are the types of trades that we teach beginning options traders, traders that have been having trouble maybe doing, they've taken some courses, or in general they know what an iron condor is, they generally know what options are, and they have a basic understanding of the Greeks. We put them into a bear trade, a bull trade, that type of thing. Now once they get more experienced and they really understand what options Greeks are, and they understand, or they're fairly experienced trading condors, butterflies, things like that, we'll put them into what we call an M3 trade. Now, an M3 trade is a completely market neutral trading style that I developed, and it's designed to teach traders to become better traders. It's an advanced trend following and adjustment trade that has a lot of techniques that help you stay on top of the market. It shows you the proper method of managing by the Greeks. You see a lot of this out there. People say, manage your trade by the Greeks, managed by the Greeks, but they're not presented properly. They're presented in a manner that you obviously know the instructor doesn't know what the heck he's talking about, which is a little bit disturbing on my end. Now, there are some people out there who are very good at this, but there's very few of them. Most of them don't teach how to do it. So this is a trade that's extremely resistant to price movement, and again, both the bear trade and the bull trade we already talked about are only managed once a day. This also is only managed is designed to manage one time per day. So let's just move forward here and look at what an M3 entry might look like. This here is a M3 trade. In M3 trades, we tend to ignore the expiration graph and focus on what we call the T+0 line, which is this dotted line, which is the representation of the value today. If I pop out of here and go into our option view software, which is, just so that you know, this is the analyze graph for that entry in option view. This is called a matrix. This shows us where we have our options. So in this case here, if you look, I bought 12 1150 options. I sold 24 1200s. I bought 12 1250s, and I bought a deep in the money call. Now, we buy deep in the money calls with M3s for a specific reason. I generally avoid buying out of the money calls. They're a low probability of making money and a low probability of protecting your position. We talked about when you change the strike level of the call acts more like a stock. In this trade, we trade a butterfly on top of a synthetic stock is essentially what we're doing here. So if I look at this particular position, it looks something like this. If I compare this to a Condor trade of approximately the same size, a Condor trade would look something like that. Essentially what we have is we have a higher probability like a bullish bear vertical. In other words, I'm not going to lose money generally on an M3 if the price goes up if I'm trading it properly. I might lose a little bit, I might break even, but I'm generally not going to lose, take a loss from an upward price movement on an M3 trade. I do have to take on any risk when I do any kind of income trade, and here I take it on to the downside. The good thing about this particular setup versus a Condor is very sensitive to volatility when the market drops. A butterfly is not. A butterfly generally holds its value very well with volatility increases and down moves. Again, that's typically untrue with a Condor. So I actually have better downside protection if the market drops in an M3 trade, and I have much, much better upside protection. And I have the potential in this particular case to make this about the same amount of money. This gives us the ability to not have to monitor the position as closely. Again, the thing with a Condor, you get a really hard up price move. A lot of times, if you look at the adjustment strategies for Condors, when you learn Condor trades, they're going to say, you have to adjust a Condor when your short strike hits this delta, and you have to do it immediately. And if you don't do it immediately, you're going to take a complete loss. But if you do it immediately, you're going to take a complete win. Those types of trading systems don't work well, and they don't work well because, first of all, you may not be available to make the adjustment at that particular time, and second of all, you don't want the win or loss of your trade hinging on a single adjustment most of the time. Occasionally that'll happen with an M3 trade. Occasionally you might say, I didn't make the adjustment, so I lost the trade. But 99% of the time, it doesn't really matter if you make the adjustment right now, if you make it later on, or if you make it even the next day. So that being the case, these are much more resilient to these larger intraday moves. As a matter of fact, I tell people do not adjust these during the day, except under very specific conditions. Coming into expiration, which you don't have to trade them into expiration, but coming into expiration, especially on an expiration day, if you're actually in the trade that long, then you'd want to manage it a little bit closer. And then, of course, with extreme gap down moves, that like we had a couple of weeks ago, that would have it wasn't necessary to adjust it intraday, but it would have benefited to adjust it intraday on that particular in that particular case. But 99% of the time, we're doing everything we can to avoid adjusting this until a specific price point. Now that price point can be 10 o'clock in the morning. We avoid adjusting between 9 and 10. That's generally not a good idea. And of course, you don't want to get too close to the end of the day. So at any point between that, then I recommend after 3 o'clock or sometime between 10 and 11 to make trade adjustments. But the point is we want to look at this and monitor them once a day. So a trade like this is very, very resilient to that, and you can kind of go back and adjust it once a day. So the design of this is to help you learn to trade and to stay in the market without losing money. This trade was not necessarily designed to make money, although it does very well. But it was more when I put it together, it's more of a function to be able to stay in the market and not lose money. Now, we can go over a recent trade that we did, which is this particular trade here, which is let me close this, which is a September expiration trade that's 56 days to expiration. Now, I'm just going to quickly go over my T-log here so I know what adjustment dates we have. So the 20th, we have the 24th, and the 28th. So if we look at a trade like this, and just another note too, this trade is the precursor to all my other systems. You can trade a bearish butterfly also from a fairly simple skill level, but this trade goes, my trading systems go M3, and then we go to a rock trade. Assuming you know the bearish butterfly, we go what we call a rock trade. This kind of leads to the mechanics of being able to do a rock trade, and then we go into what we call an M21 trading system, which is very, very comprehensive, and you really have to be very good at trading this in order to get there. So again, this is the base model for you understanding what certain market moves do in trading behind the Greeks, trading with the Greeks. So this trade here, if I go to the 20th, so we'll just move along to show you what this kind of looks like moving forward. So as time goes by, this trade is going to do something like this, right? You're going to gradually increase in value here under the butterfly. Generally, this remains fairly stable to the upside. If we start having a delta problem, we will do something to straighten this out. So I have certain limits within the program, and in this case here, I allow it to go to minus 100 delta. In this case, we're minus 52. That changes depending on where the price actually is within the program. But if I wanted to straighten the upside out a little bit, I could maybe do, actually I probably wouldn't need to do that many, but I could do something maybe like this, right? And we would straighten, well, let me do both. I do something like this and we start to straighten this out a little bit. So as time goes by and as we start to bulge here and we start to drop over here, we're adding vertical spreads in here to stabilize the line to the upside. As of right now, that's not necessary in this particular position. It's within the guidelines of the system, so we're not going to do that. But if it becomes excessive, then that's what we tend to do. Let's see. So we'll move ahead a few more days here. Right. So we're still within the system here as far as our guidelines go. If we look at this, you can see that the position builds value, and again, we're still very resistant to price moves. The reality is here is we can get a push down to like 1170 or 1180, which is a fairly big move without any particular problems. And of course, realistically, even if we went all the way up to 1326 in the next day, it's not really problematic for us. We just lose some profits, right? So very, very price averse type of a position here. If I go to all the way to the 20th, or the 19th we'll go to, right, this is when the market starts dropping down a little bit. Right here, realistically, we're actually very close to the price target, profit target of this trade. This trade has a profit target of $5,000, and we could take that money and move on if we wanted to. But I'm just gonna stay in this because I want to show you it through the crash here. So on the 20th, I'm just going to go before adjustment. On the 20th, during the day, we had a fairly big move in the Russell, 24 points. I don't know if you watched the Russell 2000 or not, but 24 points would be a substantially larger than normal move. It's a really good size move. That being the case, we got back deep into the butterfly position back here. All our risk is here, so we don't want to hold the position there. So what we do here is, for adjustments, is we roll this position back. So if I came to the next half hour, what we do is we take that position and we bring it back behind the market again. Adjusting this way puts us in a situation where I've come all the way back here, I'm giving myself some downside room, and my T+0 line is still flat when the market reverses. Generally what a lot of income traders do is they will, they'll take a Condor for an example, and they'll take the upper half and they'll roll it back to help with the problem that they're having. When you do that, you create a lot of upside risk, and a lot of times when the market comes down a lot, it reverses fairly hard, and they lose in the other direction. So this trade is very resistant to actually losing in the other direction. So if we go from here, we'll go to the following day where we had no adjustments, but we did get another substantial down move in the market, right? So here we dropped another 14 points. Our delta is relatively neutral, which means we don't have any immediate price movement risk in either direction. And we're into something like this. If we take a look at our analyzed graph, we still have a nice flat T+0 line at the upside. We have still a decent amount of room to the downside. Even though this is a decent amount of room, one of the challenges we have is we actually had a 40-point gap down in the Russell the following day. This Monday, by the way, it wasn't the largest daily move in the Russell. It was certainly one of the largest ones, but not the largest. But it was the largest gap down we ever had in history in the Russell. Very, very bad day. If you come to, say, 10 o'clock in the morning, right, this thing's down 31 points already at 10:30, and it pushed down even longer than that. One of the things when the market opens like that is you can't trade options. They didn't even have an ask price on the options. You kind of have to ride it out. But this was down 31 points by 10:30, and again, I generally don't recommend trading before 10:30. And the position looked something like this, right? We have our theoretical value, but we have our actual values way down here because of the big volatility increase. So anyway, this is one of the conditions where sometimes we'll say it's okay to trade intraday. I have a whole procedure for doing that in general with my one-on-one students, but I was actually on our forums and our Skype groups and talking about this particular day where you don't touch the trade until the market bounces, and the market bounced later in the day, and it should have been adjusted around noontime. Right, so realistically this came back around noontime, and this is the time when you would tend to make your adjustments and adjust back. However, if you're sleeping, you probably wouldn't even know this went on, and you'd be sleeping peacefully. You would wait till the end of the day. So if we took this and waited till the end of the day, the market came back down and pricing kind of went away, right? So we ended up being down 43 points here at the close of the day in a position like this. So what we do is we do the same thing. We just roll this position back. We came back all the way to here to our 1090, and I'm holding positive delta here, which would be prudent if the market's been down that far, but I'm within the guidelines of the trade. One of the things that we learn by doing trading like this is that when the volatility skyrockets like that, you have a T+0 line that's not formed in a normal manner. In other words, if we just had a volatility drop, this would pop up very high and this would drop down fairly low. And if I get a bounce in the market, I'm going to have a volatility drop. So knowing that in advance, you can kind of model it this way. But knowing that in advance and do that, I generally want to be positive delta in a situation like this and go into something like that. So had we done nothing, we would end up in a position that is similar to this. So let me close this. Only it would be down money, and I don't know why it's not showing down money. But anyway, we'd be in a position that's like this. Why is this not showing us down? I think this might have just been a temporary thing. Anyway, this position was down a little bit of money by the end of the day in a position like that. So from there, we get a significant market bounce in a very short period of time, which again, this is where Condor traders get into trouble, right? If you look 4 days later, I had to make more adjustments. I had to make more adjustments because the market bottomed and it skyrocketed to the upside. So if we go to here at 1500, right, here comes the bounce, as they say, as soon as this updates. And we're way up here past our strikes. Notice how the T+0 line has flattened out, right? As soon as the volatility drops out, that T+0 line switches and shifts. And again, this is something that we learn just by doing this over and over again. You learn stuff like that. Anyway, this is a position that needs to be adjusted, and it needs to be adjusted because of, again, we trade by the Greeks. We have what I call a volatility issue. We're too positive vega here. And we'll go ahead and we'll make an adjustment with this. In this particular case, we roll the butterfly back up a little bit and put ourselves in a position that looks like this. Right, so now we've just reset our position, and again, for the most part, this trade is a process of putting on a very safe flat T+0 line position. Gets out of whack, you reset the position. It gets out of whack, you reset the position, and that's basically how it goes. So this is how that ended up. Then, of course, from there, the market came back down again. If you look at the 8th, there was another adjustment done on the 8th. The reality is, in a month like this, when we had the market crash and things are not going well, I'm going to exit this trade at a profit number. This here is our profit number. If I was in this trade and I chose to stay in the trade, I do have what we call a delta problem. The delta is too steep. I'd come in here and I'd make a delta correction by doing some verticals, right? So I bought some of these 1130s, I sold some 1140s and 1150s, went into a position like this, right? So that takes away my upside problem and still gives me some downside room. And then I would have just traded this into close gradually. The market went up, so I would just gradually take off my my upside risk as the market climbed. So, you know, for an example here, if we go to the 11th and the 15th, just show you what that looks like. Now, because the market actually took off so aggressively from this point, we did lose some profits, but if you chose to stay in, I guess we didn't lose some profits. Sometimes you'll lose some profits. This particular case, I guess it worked out better. Realistically, we would have been out of the trade, but as far as managing it, all I'm doing is I'm gradually pulling the risk off the upside as things move along here. Go a couple more days. We're positioned like this, right? Again, we have some downside room, we have some upside room, and you see the risk is going away, and you can run this right into expiration this way if you'd like to. I believe this is actually expiration day. This is right. So actually, expiration day, you look something like that. So I've basically taken off all my upside risk, and if I wanted to, I could even expire this because I actually have so much room here. The chances of me getting hit with a problem at expiration is very low. Although I could lose a little bit here if I don't close this out because I still get some value in these longs. But anyway, that's essentially how an M3 trade would work. Just a little example there. So I guess. Kevin, I guess our hour is pretty much up here. I don't know if there's any questions that anybody has. I didn't see anything come in. Hopefully everybody understood what was going on here.
Yeah,
I do have, go ahead.
Yes, no, it was very informative, John. Appreciated it, watching the demonstration. I don't think I'm seeing any chats coming through on my side.
Okay.
Any questions coming through, but just a question for those who didn't make the live presentation, we'll be able to get hold of a recording and perhaps post it to our meeting board and so forth.
Yeah, what I'll do is I'll talk to you about what kind of access you want for this, but yeah, I'll post it up into YouTube, and we can give you a link to that where you guys can get to it directly, or you can embed it in one of your pages.
Fantastic. I'd just like to say thanks for your time this evening, John. It's a very interesting presentation. The majority of the people in the room were interested in options trading at various levels, and they stayed for the whole presentation. So that's very good. And I think you know they'll probably follow through. Those of you who are interested in what John's doing, you can visit him via his website, Lock in Your Success, and I'll put a little link up on the members page as well for the Melbourne Investor Meetup members.
Great. Yeah, I encourage everybody. Sorry to interrupt you, Kevin. I just encourage everybody to come over to the blog and at least review some of the trades that we do. I do an example of the M3 every week, real time, and also other trades, which is a bearish butterfly, which is very similar to the bear trade we looked at, and we actually trade that every single month. I don't have an example of the bull trade, but I do have something called a V Condor and a RUT trade that are both interesting trades as well. So I encourage you to do that. If it's something you like, then continue on.
I also like to add there, John, it's probably well worth visiting the Options Industry Council. It's a website that has the foundation training for free for people who are interested in learning the art of options trading from the ground up. Options Industry Council, and then someone like John is a perfect mentor to take on when you've got the basics down and you really want to see some application of the theory into real practice. So again, thanks very much for your time this morning for you, John. Early start for you, and hopefully we got a lot out of it, and we'll see you all soon at the next meetup.
Yeah, thank you very much, everybody. And if you have any questions, feel free to email me. Just come to my website. I have contact information there, and you can go ahead and do that.
Maybe we just finish off with your website on the screen again there, John. They can see the URL. And
okay, great. I'll just throw this up here quickly, just so that we have it. This is my general contact information, and I will throw up the website here quickly, which is going to be right here. So, so like I said, come on over to the blog. I have a lot of free videos. If you'd like to see examples of this trade, there's years of the trade. I just got a quick question here is, how long would it take someone to build the knowledge for an M3? It's very dependent. Generally, if you have taken programs that trade regular iron condors with adjustment strategies or something similar to that, then generally you can come right into an M3 program and learn from there. If you don't know how to do that, you're just going to be confused. So, but once you get into that, it varies depending on from person to person. What I can tell you is we've taken people who know absolutely nothing and we've gotten them on the SMB trading desk trading nearly $1 million using the M3 in as little as about 4 months. So that's pretty good, but these were people who had a general idea of the background of how options work. So you definitely want to be well versed in delta, theta, gamma, what those are, what a T+0 line is, option view analytical software, how to use it. Sometimes that takes longer than actually learning the system itself, but if you're at that knowledge level, then M3 system you can usually run with that. And of course, if you don't, we're going to have group coaching, which we're starting this month, which is a fairly inexpensive alternative to one-on-one coaching. One-on-one coaching is relatively expensive because it's my time and or my mentor's time. I love doing it. It's one of my favorite things I do, but still, you only have so much time to be able to do that, and there's so many people. It's hard to serve everybody, so we are starting the group stuff this month actually, October. So, all right, that's what I have to say.
Fantastic. Okay, John, all the best and have a great day over there.
You too. Have a great day, everybody. Thank you for joining me.
All the best. Bye-bye.
Bye.